Hello, this is Maj Soueidan with another Skull Session Investor Insight today. We're here with Adrian Courtenay, and this I'm really excited about this. I learned about Adrian after reading a idea brunch from Edwin Dorsey on the Substack, and I really some stuff really caught resonated with me. We'll get into some of that later, but really, I'm really glad to have him here today, Adrian. He's a founder, fund manager of the Green Ash Courtenay Special Situations Fund, managing director of the Green Ash Partners. I think you really, I think as far as I can tell here, you're really looking at unique special situation opportunities. You have a real nice career spanning asset management, and we're going to read learn more about that, some of the accolades that your fund has kind of earned over time. So before we do that, though, let's get into the terms and conditions and disclaimers, and then we'll talk to Adrian.
This discussion is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. This is not a recommendation to trade, buy, or sell any companies discussed. We recommend you consult with a professional investment advisor before transacting in any securities mentioned in this discussion. By viewing or listening to this event, you agree to the terms and conditions, which you can view in full at geoinvesting.com. Premium members can also view our disclaimers at portal.geoinvesting.com.
All right, here we go. So, Adrian, thank you for being here today.
Thank you for having me.
A pleasure. We got a lot to talk about. Your history, becoming a fund manager. You wrote a book. There's some really good stuff in Idea Brunch that I want to talk about. Kind of hit a nerve with me a little bit, like reminded me of some things, especially on risk, which I've had to suffer a lot of in my life as an investor. And especially you had talked about in the article really about this is really cool because um, the critical insight is that market crashes often coincide with personal liquidity stress for fund unit holders. I would really want to talk about that later too. And it's relevant today with the market doing so hot, and there's a lot of froth in the market and probably FOMO. So we'll get to that. But let's talk about Adrian. Let's talk about yourself here. I mean, let's get a little background. I'd love to hear about how you got into investing, even before you got into investing, what you were doing, or if that was something you kind of, was part of your life from a very young age. And so let's hear about your history.
Sure. Well, I started my career in investing on the buy side, and but as an analyst. And so before that, I went to university, studied biosciences, and so I guess I had a curiosity type mindset as a young person, but I wasn't someone who has been investing from age 12, for example. In some ways, I should be. I'd actually, perhaps recommend that for people who think that children might be interested in investing. There's absolutely no reason not to get started early. And many of the principles of investing, of course, are quite simple. But I really became interested in investing in choosing between an academic career and a career in finance. And turns out that I ended up in finance. And I've had a career as an analyst and really been a very deep dive analyst, I would say, for probably about 15 years. And eventually one tends to move on to running part of a fund, bucket of a fund. And if the performance is strong or reasonable, then in my case, it was the decision was taken to launch the fund, which was 6 years ago. And most of my career has been at hedge funds. And in particular, I'd say I've got experience in merger arbitrage and what we call equity special situations. But I think really it's about trying to say, what's a really great investment? And of course, if there's a value catalyst on top, that's even more attractive. And so that's a brief summary of things. Certainly, I think some people are naturally born as great investors. And but if you think of it like fighting, someone who's a natural fighter may not actually ever win a fighting tournament, because those tournaments are won by martial artists who actually have a discipline beyond their natural ability. And so I think it's an interesting path that I've taken in learning that, yeah, I don't know whether my natural investing ability is particularly special, but definitely I've focused on the discipline concept and essentially how to engineer a path that can achieve success. And so we're maybe in the middle of that journey as we speak, but that's hopefully an interesting introduction.
Excellent. And I think that what I noticed from what you wrote on the idea brunch was that you're really focusing on, it seems, risk management is a big part of what you're doing, I think, right? I mean, if I read that correctly, you seem to understand that well, and you're aware of that.
Well, I think the part of the question is how, and I'm sure we're going into this in more detail, but how can one have an advantage over the market? And so if we think of it really simply, we might say, well, you just buy an index tracker and gear it by 20%. Like that would do it for most periods. But it turns out that in certain periods, gearing can be very problematic. And so the mission and the mindset really is about how we outperform, but risk management ends up coming into that quite strongly to enable more than simply the human saying, well, I have this innate superiority or something like that. One has to have a fund that is structured in a way that gives certain, say, leverage advantages, but actually moderates risk factors as well. So yeah, it's a performance orientated, if you like, risk mindset. And by the way, if you look, an analogy I'd give you is Berkshire Hathaway, where actually for most of its lifetime, and including today, it's about 20 to 30% geared. Yet it's known for having a large cash balance. So how can those two statements be correct? Well, you have to take the liabilities of the insurance company, essentially treat them as debt to see the true leverage of the vehicle. But it's very smart that the insurance counterparties do not have an ability to coincidentally make claims with a market decline. And therefore, you have a form of non-recourse debt. And so that's an example in a corporate of how to achieve leverage in a sophisticated way that actually works in terms of risk management. And actually, there are some things that can be done with funds that create a proxy for that. And that's certainly what we try and do as well.
Excellent. Now, I know that from my experience, of being in the market, you start to learn that if you're not paying attention to risk management, you just like you could have all these wonderful gains doing so well, and all of a sudden, boom, overnight, you weren't prepared for something. And I think a lot of us go through this kind of wash and repeat cycle a lot of times through our investment career, where you don't, and sometimes cash is sometimes the best risk management for some of us, right? I mean, you just have enough cash because you don't need much cash to work off a bottom, right? So if your portfolio is down 50%, but you have 20-30% cash, you can make a ton of money on that 20-30% cash on a rebound, right? That's one way. That's the way I've been looking at it lately. Because I spent a lot of my time in margin, many, making a lot of money, in bull markets, but then those really quick, swift moments, humble you very quickly, sometimes. And you always want that cash at that time. You don't have it, right? But you knew if you had it, you could do so much with it.
Yeah, I mean, I remember in the 2008 financial crisis, and everyone knew the stocks were. This is during the crisis, not preceding it, but during the crisis, it was obvious all these companies were drastically undervalued, right? It was not like, but no one had any money, so no one could buy. But yeah, I mean, the market can go in that direction. It can go in euphoric direction, and then in just a completely indiscriminate selling. And so there's various ways to do that. I think if it's hedging, you really need to pay a lot of attention to tracking error, because you can have a hedge, an idea of a hedge, but it doesn't necessarily mean it's going to work. So I think a properly risk-tested tracking error system with hedging can be sufficient to essentially create collateral, a sort of equivalent to having cash at the bottom, or as you say, the interesting thing about having a net cash balance, which I typically don't do, but I'm not against it. And I do consider most merger arbitrages we do as cash, in the sense that, if you put your money in the bank, it's probably buying a treasury, it's buying a security. Well, we can buy a security that just happens to pay us 2% more than the current price in 3 months and is enforced through a court. So you can think of merger arbitrages as short-term equivalent enforcement to treasuries when they're robust. But the interesting thing, as I say, I don't typically do it, but I can see the merit of doing it, is if you force yourself to have a cash balance, it also forces a lot of discipline into what you're going to buy with your equities, because you know that you actually, there's only a certain amount of collateral you're going to allocate to equities.
Right. And as you just saying that you are usually pretty much fully invested, but you're hedging, right? I think that's part of what you're. Is that the? Have I read that correctly? An idea branch? Is it based?
My sense is that is the best approach, because it depends obviously which equities, but if one can find businesses that really are robust, have monopoly or duopoly type positions, have really high barriers to entry, and have something that allows them to deploy their capital. In other words, a tailwind such that their opportunity within their market position is growing, then it should be possible to create a double-digit, whether it's low teens or something more, but a double-digit type of return, and the hedge can moderate the shock scenarios and cure for the type of thing we're talking about, where it's not. The point I was making in the ideas branch interview is it's not about the knowledge that one shouldn't sell at the bottom, so to speak. It's about the inability to determine when you sell. Because if there's a financial crisis, and we can talk about why these are inherent features of financial markets, it's not that somehow they can be cured, then whatever it's going to be, or someone's lost a job in the family, or the interest rates have gone up and you really feel you need to pay off your mortgage or something else, you become a forced seller. And so the print from a fund that it's done X% per year is often not the actual unit holder experience, because of the forced disadvantages they have on when they redeem. And so a fund structure that can cure that, and particularly when the manager is invested in the fund, so it has exactly the same type of consideration, it brings a certain additional advantage.
Okay, great. So if you look like a 2008 scenario, for example, right? If you were you're going into that you're going into there. How would you? I mean, how would you look at that? How would you have positioned for that? So you're not predicting a collapse. You're not predicting it, right? But are you basically preparing for the unknown, Adrian, or are you actually making predictions on what could happen? I'm very curious how you're approaching that.
I mean, I think there's a general answer I can give you, because that, let's say you can take the COVID shock, right, which happened to be cured by central bank action, and the difference with the 2008 crisis was that the inflation was much higher, and so the central bank really felt a lot more constrained before they were willing to act. And there's a conflict in the central bank mandate. They want to have low inflation and high unemployment. Well, the problem is often you can only choose one. And so if you choose to stop inflation by raising rates, then that removes the central bank ability to address market price decline. And so I think what I do, for example, one of the risk management tests we do is we continually run the fund as a constant model through COVID. So we replicate all arbitrage behavior through COVID. We replicate all trading equity behavior through COVID. And we say, well, what happens if that happens tomorrow? And the insurance or the put options we buy are based on eliminating a double-digit exposure to that. So essentially, we say, look, if there's that sort of market shock, we can be exposed to single-digit declines, but we're not going to, or we're running the fund in a way that theoretically prevents double-digit declines in that scenario. Now, you can prevent all declines, but you end up with such a high wastage cost in terms of insurance put options that it really destroys performance advantage. But so I think it's a sort of happy medium that investors can tolerate if you say a single-digit decline. The nature of crises is generally that they are very difficult to predict. and because of the self-reference circularity to them, etc., it's not necessarily, we think about the future sometimes in a way as if it was known. Like, can we predict if I get up tomorrow and put that shirt on or this shirt on, for example? Well, actually, it's just I'm going to choose at the spot. It's not predictable, and so lots of the future is like that. And so I think prediction of crises is a speculative thing, but we can recognize in history certain coincident conditions that, if you like, raise the probability of crises, and that might influence how much protection one might choose to have. So, for example, at the moment, new Fed head coming in, say early next year, clearly a dovish choice is being signaled by Trump. There isn't something that's clearly indicating higher risk in terms of a more hawkish stance from central banks, and we have high government debts, and ultimately that's a monetization type trajectory that I would say is most probably the West chooses to deal with that, and that's also reasonably positive for equities. But of course, those two statements I made could be at some point in the future in reverse, and then it would be a higher risk type environment. But again, I would say far from predictable in terms of outcomes.
Right. So I want to try and put this like in terms where the average investor can understand what the strategy is all about, right? So I mean, you talked about it a little bit here. The merger arbitrage holders are short duration investments, typically under 6 months, with strong contractual protections and limited market correlation. These positions generate yields that comfortably exceed our financing costs, creating positive carry. Just give us like some scenario. Just put it all together. Put one of these, if you can. I don't know if I'm asking the right question. Like walk us through how this works. Like how this insurance works or this hedging works in the context of your portfolio.
Well, I think at the core of any great investment product, fund, or personal account, however you're going to do it, or even theoretical approach, is investing in great companies. And so that's one part of it, and certainly that's the core of what we try and do. The question is, as we talked about, can we improve beyond that, and offer something that has additional advantages? And this is really the emergence of the hedge fund. And there's the macro model where the manager, I would put forward, generally takes a speculative approach to certain movements in the market that are uncorrelated to the equity market, and therefore tries to create a return that is independent of those big pricing down periods. The other model is the long-short hedge fund. And then they were on a short book with their long book. And the short book, again, has speculative elements, primarily because the equity price is both an indication of the fundamental value of a company, but also a currency it uses to make acquisitions, pay staff, using options, etc. And so if you have a correct thesis on a short, that the business is in trouble, but the price starts rising materially, they can actually use that as a currency to make an acquisition, which may acquire the business that cures the problem that they had before. Mm-hmm. So because you have that self-falsification aspect to shorting, which is the opposite of a long side position. In a long side position, if the share price goes against you and declines, the company will buy back stock, so they'll make you more right. In a short position, if the price goes against you, they'll make you more wrong. And so I think there's a speculative aspect to both the macro model and the long-short model in addressing safety aspects to investing, in particular repricing, materially repricing down in the markets. And so my approach is to say, well, why don't we have the core equity book, great companies, if they've got value, we can find one with value catalysts even better, but put option protect it on the index, closely match the tracking error between the long and the index such that we don't have a dislocation issue there. And then do we just have a performance drag because when you buy put options, essentially they decay and it's a certain cost per month? Or can we fund it using some other means? And it turns out that if you buy short duration arbitrages, you can create yield, which funds in a quite a correlated way your put option protection. And you can think of arbitrages essentially as writing puts, right? You're insuring the seller of the takeover situation against failure, whose probability will be aggravated in problematic market conditions. Mm-hmm. And in the put options we're buying, insurance. So we're selling insurance and buying insurance and achieving a net yield, and that creates what I call a positive carry hedge, but one which doesn't have the speculative aspects of short selling or of the macro side of things. So I would, as I've come to run this model, and it has taken some optimization, I think of it like an investment model where we can invest in great companies and be protected. And the investment model that comes out of that type of approach still has risk. It's just not market risk. It's essentially business risk. And so that's how it all plugs together. And so simplistically, you might say, well, generally, it's an investment, we're investing in companies. But when we really get into it, you say, okay, interesting. There's arbitrages here. They're paying for put options. And that's how it all works. It does mean the fund runs with gross exposure, say, at 180% of assets. But half of that, or slightly less than half of that, would be arbitrage yield. Very robust situations we can find in arbitrage, which is certainly not all arbitrages. And so actually, in terms of risk deployment, we might be 20% geared or 10% geared, but it wouldn't be as high as the gross exposure figure.
Okay, so is the crux of the strategy selling puts, getting premium? Is that
buying puts essentially selling insurance by buying merger arbitrage?
Right. Okay.
You use the yield to then buy puts. So you're selling insurance and buying insurance at the same time. The yield from merger arbitrage is far higher than the equivalent, if you like, market exposure you can buy in protection when you buy put options.
Right. Great. Excellent. Now, this is not a strategy that the individual investor is going to be able like really employ on a constant. Is there a constant rebalancing of these hedges, or I'm calling them hedges, or these insurance?
It's not. We can be a little bit relaxed about it. I mean, I think we tend to buy them 6 months duration out, and the market, if it rallies, it's having a good year, but it's only up, it's just over double digits. It's not. So I think we buy the puts, say 10% out the money, and we may refinance them, once every 4 months or something. But it's not a. It's ultimately an insurance against disaster. We're not trying to finesse it so much that. Right. We're sort of fine tuning the hedge every day.
Okay, excellent. So let's get into your some of your strategy here. I mean, I'm just looking for your long book. I mean, yeah. Are you looking globally? Are you looking big cap, small cap, minor cap? Give me an idea of what that strategy looks like.
Well, we hedge with the S&P 500 put option. I think that's really just by far the cheapest way to hedge in terms of liquidity, et cetera. So it does mean that we want the long book to be primarily S&P 500 type of companies. But that might be American big cap. It might be listed in Europe, for example. So you don't have to be so explicit. But I would say 70% of it might be S&P listed. In terms of I think the reality of great investment opportunities is US focused. It's that might change, and at times I've had more of the portfolio in Europe, but it is the way I see it right now, and I think we can all see it with the types of companies that continue to come out of the US. So it would be a US focused product, and the way I think about the capitalization is really that there is a tax on smaller capitalization.
Test.
Caps, we would have lower leverage in the fund. Interesting candidates in the small cap side. I mean, certainly go through some of them, or mid cap side, but my sense of it is more like the barbell approach, and so the bulk of the barbell should be in the bigger cap side, and then if we can find something really interesting, maybe in the smaller cap side. And in arbitrage, there can be more interesting things in smaller caps as well, because it's a little bit less efficient. And I think the other thing, certainly I've got wrong in my career at times before, is not to think more closely about survivorship bias influencing the data I'm getting, which is most relevant for smaller caps. A lot of smaller cap businesses may fail and you just never read about them. So because it's private or maybe it's listed, but it doesn't impact the index. So no one's talking about it. Where in a large cap business, I mean, it's going to be very much in your data stream if there's a big large cap failure. And so we have to be a bit careful in, essentially, I could put forward some businesses that look just like Apple, when it started, well, maybe there's a new business that's emerging and computing is just like that. But there was a lot of businesses that looked like Apple and failed. And so we have to be careful of that survivorship bias in small cap investing as well.
Excellent. And so what I'm hearing here is that you're really a long investor. You're not really going short. You're primarily a long investor, and you're not shorting.
Exactly. We don't. I mean, again, this is really about learning. It's not philosophy, so to speak. It's more about one learns as one goes, and just certain things you realize over time you shouldn't do. And one of those things is I'm not going to expose the fund to potential unlimited loss. And when one shorts a stock, however improbable, there's a possibility that you get one of these extraordinary short squeezes. And so you can create protection in other ways without being short stocks. And of course, with a put option, the more you're wrong, the more the market goes up, the more the value of the option declines to ultimately to zero, but it can't create a liability beyond that. And so you have that inverse case of very precise understanding of what the exposure is, the maximum exposure you could get in a negative way from those options. So I'm not. I've had actually some success in short selling in past of my careers. At that particular point, it's about 10 years ago, it was like the highest alpha generator. So it's kind of sad to give it up, but that's been my learning.
So you're looking at these. So I would say when you look at, is there enough of this merger arbitrage opportunity for you in what you're doing? Is there a lot of it there? And is it?
Well, I think merger arbitrage has changed, and it does depend on the environment. And so there were periods where merger arbitrage, there was more deals. Not at any one time. So right now, our systems track, say, about 200 live merger arbitrage opportunities in global developed markets of all sorts of capitalizations. Going as low as say $150 million type capitalizations, but that can be 300. So it can also be as low as 120. So it does change. What's missing in merger arbitrage at the moment is animal spirits at the smaller cap size. And if you think about the type of animal spirits we're seeing in some of these big caps currently, it's the inverse of that in merger arbitrage. It's very rare to see competitive bidding situations, and when we do see them, it's like, here's another offer. It's 1.5% higher than the last offer, and people are very timid, I think, for whatever reason, in that idea of outbidding and saying I'm right and you're wrong. And so the golden period for merger arbitrage is when you can put money to work in an arbitrage. You can maybe make a 6%, 7% yield, but someone comes along counter bids. And I've done a situation before where I was actually activist, and we had 100% upside ultimately in the situation. That's quite rare now, but there is a reasonable volume of opportunity still.
So I'm curious, when you're looking at these merger, because we're very like at GeoInvesting, and we know the strategy we use. We have this term called information arbitrage that's available in the nano cap world, where the actual information hidden in scripts and SEC filings is just there's a huge gap between how that should be valued, right? And so we even do look at like situations where a company is announcing a merger, or there's an acquisition, or maybe a sale of an asset, and it's not being priced correctly in the stock. And so I see some, generally we'll see, for example, sometimes I would say 10 to 20% dislocation sometimes in these, or more sometimes, depending on what the situation is. I'm going to give you an example today, by the way, too. This happened today. But I'm wondering, so in the stocks you're looking at, what are those? What's the opportunity you see? What's that spread look like? Just between, are you seeing like a 5% opportunity between in this merger arbitrage spread? Or is it more? Because you're playing in a bigger cap market, probably, where there's less of that kind of arbitrage to play, right, in that gap.
Yeah, there's obviously the investment side and the smaller caps and the arbitrage side. And in arbitrage, again, I've really learned to focus on safety. And so you can have quite a lot of success by letting the chance of the situation play out, but not having to traction, rather than saying, I'm going to essentially pick something that's really hard and complicated, but there's a 20% spread. You know, when there's an antitrust issue in an arbitrage, ultimately the decision is by the regulators. They would like to pretend otherwise, but it's quite, you know, it's not necessarily based on rules. The reason there's an antitrust dispute is because the law hasn't quite been written to properly address the situation.
Okay.
So it's ultimately often just a group of humans sitting around a table at the regulator and saying, well, what do you think? What do you think? Okay, let's go with that idea. And so you can definitely see large spreads in arbitrage, but they often fall into this fuzzy area where, if you're really honest with yourself, it's a gamble. And so I think we can, in terms of safe arbitrages, we can still pick up, you know, well into the double-digit returns as a book.
Nice.
And some of it is because there's a 2% spread, but it matures next week. And it's actually the timeline of the arbitrage that people haven't figured out. And some of it is because, you know, I mean, we have a situation, Tellurian, I don't even remember that company. It was a development stage LNG plant. And it was subject to a takeover, and it was very well enforced when you read the documents, etc. But it just happened the founder of the company, who had left, had problems in terms of corporate governance type behavior. And you know, that would trade at a 10% spread, and I think there was probably about a 50% annualized return there. But you know, so they're out there, but most of it is you know, and that had the safety aspects as well. So, but I would say people say it's like picking up coins in front of a train. There is that kind of daily work and the daily grind, and you pick up yield, rather than saying, gosh, this is the best, you know, just amazing opportunity here, etc.
So merger arbitrage is like one piece of it, where you have at least you know what the stock should be worth, and you know where it's trading at, and there's a certainty there if everything works, right?
So in theory, you have the enforcement concept in merger arbitrage, right? Where if you think about investing, it's like, I want to have complete asymmetry. I don't care if I'm right or wrong, because, and that's if you like value investing, right? It doesn't matter if I'm right or wrong, because the price is so low that even if I'm wrong, I probably make some money because they just liquidate a company or something, right? But the other thing you can look for is enforcement in investing, where it's, if you're wrong, you'll lose, potentially it'll be a painful loss, but it's so clearly enforced by law. There's no out in the contract, etc. And you know, that's really what most merger arbitrage is about.
Okay, cool. And before I get into a little more, I didn't even ask you this yet. I should have asked you, like, are you allowed to talk about some of your performance? Do you want to talk about your performance, how you've done?
Sure. Yeah, sure.
Give us an idea of like what kind of returns you've been able to get here using this strategy over time.
Yeah, I mean, the fund has done, so 6 years, it's done 12% annualized, with almost no correlation to the market at all. I think the correlation to the market is 0.1 or 10%. And so, you know, we actually, in the first 2.5 years, had some very strong periods and was ranked the #1 fund in Europe. But the fund was part of a firm which went through some difficulties, and we transferred the fund to a new firm. And we had to renegotiate financing agreements. So for a period, we simply ran it at a lot less leverage, or no leverage, or, you know, low gross exposure. And I think, you know, there was a period where I just said, well, during this period, we're going to deliberately slow things down a bit, do a lot of fundamental work, more systems building. The systems are very valuable in investing, merger arbitrage, tracking systems of other managers, history systems in terms of litigation decisions in merger arbitrage, for example. And so more recently, we've had a single-digit rate of compounding. But I think the strategy, if it's run well, is very powerful and can do something very interesting in terms of returns. But you can't and shouldn't try to force performance. Ultimately, what we should try and do is produce a pleasing, safe result. And, you know, sooner or later, maybe a new situation comes up and say, wow, you know, this one could really make a lot of money. But right. Yeah, that's been the performance.
Great. And so how deep do you get into special situations kind of investing? So you have the merger arbitrage is one certainty.
Yep.
Are you also looking at potential asset sales, spin-offs? Are you looking at these other kind of opportunities out there too? And are you also using any type of similar strategies there that you wouldn't in the merger arbitrage?
Yeah, I mean, certainly, I think as one learns through the path of investing, so my sense is that we should put business quality first in terms of when we invest, and that means monopoly or duopoly asset, very high barriers to entry, and some sort of tailwind, which means they can reinvest their capital. And actually, if you apply those filters honestly with yourself, you'll find there's only about 200 companies in the world that meet them. So to some extent, if we get an excellent match of those characteristics, I would say that is a special situation because it's just extremely rare. But on top of that, you will then find in these situations that there can be transformational things going on. It might be, like you say, a spin-off. It might be a renegotiation of contracts. An example, is right now would be Formula One. So you have a clear monopoly. You have extremely high barriers to entry, and if you look for the last 80 years, there's been no scaled competitor to business. But you also have the linkage to social media, to essentially short video snippets that they can put out there, and digitization of the product, virtual reality, etc. There's a lot of growth tailwinds on that business. So that would meet those quality criteria being very rare. But what's very interesting is right now you have Apple and Netflix in a bidding war for its US broadcast contract. And that contract terminates this year. So there's a sense of that the outcome of that auction will occur in the next few months. And so that is a very interesting special situation where you have the business quality, but you have this value catalyst. And obviously one wants to do the work there and understand what the likely outcomes are. And I would say that's very interesting work when one looks at that.
Excellent. There's a stock. This is now we're on the subject. I'm just going to kind of show you how these inefficiencies that occur in the nanocap markets here are really interesting. So there's a stock here that I own and owned it for a while, and we just we actually got the CEO on the program. I think it was 2 weeks ago, and the symbol is PXHI. It's Phonex Holdings. And it's basically a company that basically creates a marketplace to sell using electronics, mainly phones right now. Like that's what they're doing, like iPhones, for example. So they go buy their legacy business of buying these phones on trade-ins and then reselling them. And that's kind of B2B kind of a scenario to other wholesalers. And they just recently sold like in a bunch of cash, and I think almost 50 million in cash, I think, close to it, by selling 80% of the business, and so they had less cash in the books, and stock was selling basically. You took the cash. At that time, it was selling for cash per share, basically. So the stock was selling at $1.60, and cash per share was like $1.40. If they sold the rest of the 20%, which they're going to probably, it's $1.95. So a stock selling, for below cash per share, basically zero debt. They got rid of their worst asset actually. So they lost almost like 80% of their revenue, right? But what was left was very all software revenue. They have a platform they sell to other companies want to do this, like 80% gross margins. But it screens really bad, right? Because all you see is this decrease in revenue, right? But the software revenue, it was the first time you got a look at the software revenue because you never knew what it was, how good it was. And it's so when they were doing say 45 million revenue a quarter, now they're doing 2 million a quarter, but it's increasing at 30%. But they're doing more EPS. So it's really interesting. And this is an OTC company, by the way, okay? And so they obviously proved they had an asset, they sold it. But so now, fast forward like a month after the asset sale, they announced a special dividend. And so the stock basically is sitting around this $2 a share, pops at $3 or so, sells in at $2.50. Now that the special dividend was $1.15, it's basically a 40% dividend yield. So as we all know how this works, you get a dividend comes out and the stock will fall by the $1.15, right? So the stock is sitting here today, because it went ex-dividend today, so the stock should have fallen today. You had to own it by the end of the day yesterday. So the stock is down only basically 8% here. It's basically selling it at the same price it was when the dividend was announced, right? And the stock's probably actually worth like, $4. So it's sitting here. So today, like you could own all the stock. And the average daily volume of stock was basically coming into today, was where is it here? 22,000 shares, right? It actually a little less than that because it's been taken up. Today has traded 180,000 shares. So you seriously like the everyday investor could have, this is a great arbitrage. You could basically this 40%. Maybe the stock will fall to water. I don't know. But because the stock is so undervalued, it defies all the rules that the stocks, it's the OTC. I mean, I'm just flat. I've never seen it before where it was that dramatic. So you basically earned 40% yield on the stock you owned. You could go back and just sell it to somebody else right now, whatever you realize all that if you want to. Which I thought was really interesting. Yeah,
I mean,
that's crazy.
Market efficiency is an interesting thing when you think about, well, why does that exist? Like, what causes that? Like if you and I are talking about something and suddenly there's like 700 more of us, suddenly what is it just right? Because there's a herd of people doing it rather than two. It's like, what actually causes it? And but it is linked to the somewhat obviously the intellectual throughput and resources of the counterparties that are engaging in the buying or selling in the security. And so if you have situations of lower liquidity, definitely inefficiency rises. I think the problem is that if you think about, you can think about inefficiency being just as much a problem for the investor as efficiency, right? Because if it's inefficient, well, maybe it'll just stay inefficient for the next 10 years. Or worse, it can trade down and then management can end up not being your friend and buy it a bit cheaply from you and force a takeover at low price. So I think catalysts in low cap situations are very important, where there's some sort of, you just get the sense of a forcing function, right? So in a takeover, in a small cap situation, that arbitrage is a forcing function. And if it's very cheap, and there's evidence of, say, a stake builder who also wants to buy the company, you have a great forcing function combined with inefficiency. And to your situation sounds very similar. There was essentially a type of, I think of that almost like an arbitrage, right? Because you've got a cash payment coming to the shareholder, which is, what was that? Like sounds like, what percent of the market cap was the dividend?
Like it was like a 40% dividend yield. It was a 40%.
Yeah. So that doesn't surprise me. I think, unfortunately, I've experienced a higher than desirable level of corporate governance deficits in small caps.
Sure.
And it could be wrong, but it's like, is that rising in the market versus the last 5 years? My sense is like, there just may be a growing problem there. And so that type of behavior where, I've seen takeovers where like, it's a fully binding specific enforcement takeover, it's small cap, and like, if the bidder walks away, the company can sue for unlimited damages, but the management just like, no, we're not going to do that. We're friends with the bidder. You have an obligation to sue.
Yeah.
So that would be one example. But yeah, I mean, your type of situation definitely exists. There's a situation in the UK, and I won't name the company because I'm going to say something about management as well. But this is like 10 years ago. It's an airline company, but it's an unusual airline because they first of all operated with big net cash balance, no debt. And secondly, the area where airlines typically have off-balance sheet debt is through leasing the planes, but this company happened to own all its planes. So it was like 200 million of cash and 200 million of plane assets. It's trading at like 80 million or something. And it was profitable, and had been profitable for 20 years, including through the financial crisis, still eked out a small profit. So I was just like, unbelievably attractive. Good business. Yes, not a complete monopoly, but it's this good, solid business, very rich asset ownership, massive cash balance, etc. Owner managed, but only a sort of 35% stake. So not. Anyway, we met the owner and the CEO, and he was, he just pushed everyone the wrong way, abrasive, kind of threw swear words in every second sentence. And you sort of realize why people don't want to buy the stock. But that stock since then to now, is probably more than 20x. I mean, because it's a solid business. And so that sort of thing does exist. But as I say, my sense is that's the don't know whether it's the risky end, but it's the unusual end of the barbell of the portfolio, rather than that, you can really
Yeah,
stack a portfolio.
there's not enough of that to build a strategy. But there is interesting going on now. What I've noticed in the small cap world, Adrian, is that there's this value trap unlocks going on, more so than I've seen in a long time. And I don't know if it's because so these are stocks with relatively clean capital structure, lots of cash, but with a team that hasn't done crap for years, right? And they get so cheap. I start to wonder, well, maybe this is a situation where maybe they're afraid of activists. I don't know, that they actually start deploying the cash and doing things, or is it the fact that there was nothing to do, and now there's something, it just things happen where there is a reason to spend the cash. But I'm seeing a lot of these kind of like hated smaller cap, mega cap companies that even nano cap investors hate so much, like, and they're tired of, that are doing stuff with their cash now, like, and just getting incredibly undervalued, trading at cash and below cash with zero debt. It doesn't make any sense. And you wouldn't think it would exist. And it's existing enough right now to really get me interested to say, okay, there is a time, and it doesn't last forever, as you know, right? It's going to eventually arbitrage away. But I'm really curious to see how long that lasts for. I'm really excited about that in our little world over here. I mean, you look at big caps. Like if you find like a value trap in a big cap, there's probably a reason for it, right? I mean, the market's smart enough to know.
Yeah, it's like, would you prefer to buy Netflix at 40 times PE or 5 times PE?
Yeah,
it's like there's something going wrong with the business, really.
Yeah.
But
over
yeah,
here, it could be investor fatigue, or nobody cares.
No, I mean, it's important to remember as well that shareholders are fully enfranchised with our rights. So you can sometimes see management acting in ways that you don't like, but there's no legal diminution of shareholder rights versus 80 years ago. It's fully enfranchised. So these situations, they do need sometimes shareholders to aggregate, or you find one activist on the register already, and it's essentially just a sense of something is changing here.
Yeah.
It's the atomization of shareholders that's the problem, and leads to a sort of safety attitude. They just say, well, I'm going to be CEO for 20 years and have this salary every year, and I don't really care if the business does that well or badly. And it's
exactly. Yeah.
So,
there was one that I was a commitment on, actually, and it's just I would say it's not dark, but they never talk about they issue 4 releases a year, their numbers, don't really talk to the industry much, or investors much. And they found a form. It's a Form D today, which is you can make like a way you can these small guys can raise some money without like registering. And it's a small raise, right? So, but on the form, it asks you, okay, who you are, what's your company do, maybe like check some boxes off. And they're a public company. They do file, reports. I think I don't know if they filed with the SEC yet, but I think they're in the OTC. So you can see how big they are and what their revenues are. And so there's a checkbox that say like how much revenue you do. There's like all these little check boxes, 0 to whatever. And there's a none. They click none. It's obviously a seal. The guy just saying, F you, I don't care about anybody. I'm just gonna put none over here. Well, you obviously have a disclosure and your filings. Well, we know what you do. That's how you know you have a team that doesn't give a crap, right? And it's really annoying in small cap land because there aren't a lot of activists who are willing to go after some of these companies because it's not worth it. A lot of these have high insider ownership, so because of hard battle, right? And a lot of these actors can't get big enough positions.
Yeah, it's hard. I mean, I've looked at that, obviously as a strategy as well, and activism is very powerful, and it really does. If you know what you're doing, it's a very powerful strategy. But what you find is there's almost like an exponential decline in trading volume as you get to the smaller cap. So you could buy a 5% stake in a mid cap, but if you try and do it in a small cap, you'll move the price, or you can't get out if this is wrong. And so I'm willing to make a public statement on a company in a small cap if it's a merger arbitrage, because ultimately I have the cash coming in 2 months or whatever it is, and I can agitate for a higher bid or a different way of structuring it. But on a small cap, you often will have no real liquid exit potential. So yeah, it's an interesting area. I mean, in the small cap side as well, you can also get very strong business models. It's not just about the pricing. You can get some very strong business models. I mean, one of the ones I think I mentioned in the Edward Dorsey Ideas Brunch interview was Fever-Tree. It's listed in the UK, but it's the largest tonic waters, mixers, ginger beers premium company in the US as well. So most US people will be familiar with the business. It's an excellent quality business, and it happens to have done a transformational deal with Molson Coors, so it has that special situations aspect. And it's not, it doesn't have more cash than the market cap or something like that, but it trades at about 2 times revenue, which for a business of that quality, and given the revenue transformation that comes from the Molson Coors agreement, it's definitely worth a look in terms of a different dimension of what you're talking about, of just this lack of market efficiency at the small cap level.
Yeah, and I think you do see it at the small cap level too, not just the micro and nano. You can see that some good opportunity in small cap area, especially if they're less liquid companies. So I guess a good thing to segue here is like, how do you find your ideas? What is it simple screening tools? Are you reading A to Z? What are you doing here to find your companies?
Well, it's a good question.
You want to reveal a little bit?
No, I mean, I'll definitely reveal it. There's no problem with that. It's just kind of where do you start? Because it's always a multi-step process. Lots of different things going on. But as I say, I tend to think business quality first. And so I'm interested in monopolies. And I don't mean monopoly like, oh, you own the whole market. I mean, realistically, someone with 70% market share has a monopoly. Because you don't want, if you've got 70% market share, I don't actually want to extinguish the small guy, because I have to produce all my pricing so much that, and great, I own 100% at like half the profit margin. It's not worth it. I might as well just have 70% at the full profit margin. So I kind of mean like an economic monopoly, when someone has essentially the optimal business position in a market. And I would say it's worth people just maintaining their own list. You read more, here's another one, and it's not going to be that big a list, but it's, you can get well over 100 companies that have those characteristics. And it's also companies that have shown an ability to defend their monopoly, and that, we shouldn't overvalue the information that's coming to us today. It's just a snippet. What about the last 10 years or 20 years? And
right.
and all the things I'm not studying, because I don't actually know what was happening 10 years ago, but I can just see their market share was the same. So there would have still been challenges to them 10 years ago. It's just I don't actually know what they were, but I can see that basically the company, seemingly whatever challenges come at it, can defend its monopoly. And the way we should think about the current day is a reasoning process on what I can see. So there can be problems. And you can have a company with a 20-year monopoly or 20-year member monopoly, and you do actually have a problem today. So it's not that the track record is like the Bible, but it definitely is an important input. And as I say, something with a tailwind. I mean, there's lots of tailwinds out there where companies are not raising money, so they don't talk about it. They don't go on the media. Air flight is a very interesting growth market. Every year, people are flying more, and flight's getting more efficient. And so, I mean, I'll give you an example in Europe. This is not a stock I own. It's just one I've seen. It's interesting. There's Fraport, which is the airline business in Germany. It's Frankfurt Airport and a number of other airports. But their core airport, Fraport, Frankfurt Airport, is going from 2 terminals to 3 terminals, and the construction is finishing early next year. So that's, if you like, in the special situation category. It's a transformational change in the business. Now, if you model that out on an airport, it looks like about 14% free cash flow yield. So, that's very unusual for their airports business, and normally, something like a 6% free cash flow yield.
Yeah.
And you have a tailwind because you have a monopoly asset, and you have a tailwind because every year there's more and more flights. And the airline businesses are poor businesses in terms of over time, they don't actually, there's too much competition. So essentially, we're all making more revenue, but no one's making any money, where airports are very different. So I look for those concepts of monopoly and try and find ones where there's some sort of change. In the US, you have Vita Coco, which is a 70% market share in their product, right? It's basically a monopoly. listed,
Right.
well-run business, profitable. And so, these companies just should be stacked on the list of interesting targets. There's a company in Sweden called MIPS. I don't know if you know, this is, again, a mid-cap company which makes safety harnesses for helmets, but they essentially are the industry standard. And there's no one else with an equivalent embedding into helmets of this particular safety gear. And essentially they're a monopolist in it. It's, the number of helmets in the world is not just for cycling or motorcycling, but work site, construction sites. It's a huge addressable market. And it's very easy to sell something saying, if I say to you, if you don't buy my product, you're endangering your workers. It's quite an easy sale process. So I make a list of trying to find companies that have those criteria. And I also do think it's very valuable to have a number of other managers that you track. And, in my systems, we track more than 100 fund managers, but there's probably 10 that I really look at very closely in terms of what they're doing. And it's not because somehow we replicate their portfolio of someone else, but you can think of it as a form of underwriting. I can pick the stock, but I'd like it to have been picked by one of my top 10 managers if I'm going to scale it and know they've got great teams. And you tend to find that, another way you can think about it is, I don't really want to know what this great hedge fund manager or investor is saying, because no one can really translate in words their true principles. The way to understand someone is to look at their holdings, look at what they've bought, and then study them. You say, I see, this is exactly how they think. And they only give a proxy for it when they speak publicly. And so I think that's also a very good way to generate ideas, is to have a sophisticated system. And by the way, you can build these systems quite effectively now using, the SEC's got an API, so you can code stuff for these systems. And using AI, it's not so hard coding anymore. You can get a long way. So
that was my question. Like, how do you use AI in your process to help you? Ideas
I'm like a new coder with AI help, but anything I need really, we can build now with coding quite effectively. And it's a bit like a spreadsheet where you're not, really doing I'm not doing the, all the stuff that's going on behind the scenes in the spreadsheet, but I am controlling the key toggles. And then you can get AI to build code that way and get it to build it in a way. But you can even write, in the first section, I want the key toggle fields, for example. And so you can end up being quite effective in coding. So I'd say, look at that concept of duopoly, monopoly as one thing, and also look at other managers. But in a way, I'm speaking as a sign of the times, because I think if we were in the 2008 crisis, I'd be saying, do a net asset value screen, right? Because that was just where we were.
Sure.
But you tell me otherwise. But I think a net asset value screen today there's going to be less companies that you're really excited about their prospects in those sort of discounts.
Absolutely no. I'm going through that right now with the market at that high. It's hard to find some of these things you look for that pullback. You're waiting and waiting and waiting. It's harder and harder to find them. Yeah, I mean, I find myself going down the food chain even more, like liquidity and nano caps. I'm digging and burrowing into where no one else is trying to hide, but to find them. But yeah.
I mean, one area I found, this is a while back, interesting in screening, is companies that don't screen. So you can have a development stage gold mine, right? Very valuable NPV, but there's no revenue, zero. So it's like it doesn't come up, and the NPV in gold mines doesn't get onto the accounting balance sheet. It'll be a feasibility study, etc. So you get exposure to the gold price, and sometimes there is a certain experience needed to do. I think gold mining is maybe the most sort of safe area in terms of mining stocks, but there's a certain experience needed, but it's not like rocket science. So you just need to become a little bit familiar with feasibility studies and how they work, and gold grade, for example. And it's interesting. You can find some good companies precisely because they won't come up on anyone's screen because they have no revenue or book value is exactly why they're trading at an 80% discount to the feasibility study. Right. And what's interesting in gold companies as well is that gold mines, development stage gold mines, is you can think of them as having geological leverage. And so what I mean by that is, rather than financial leverage, where if the price declines, you have to pay some margin call or liability. It's basically a problem with financial leverage. In geological leverage, it's the fact that you have a fixed extraction cost and a floating commodity. So the mine is going to be developed, say, in 5 years. There's no cash upon you today. So there's no actual problem in terms of asset viability, as it were. But if you had, say, let's say you had 100 units of gold in the ground and 90 units of extraction cost, so your net NPV is 10, and the gold price goes up 10%, your NPV is just doubled to 20.
Right.
So you can sometimes find companies at a big discount to value, and just a 10% move in the gold price is, not much in terms of the current change there, and the NPV is doubling. So that can be an interesting area to look for opportunities as well. And there are certain investors in gold who are somewhat like activists, and you can follow those investors as well.
Great, excellent. And do you have any particular pitches you want to talk about at all right now? Or you've given a lot of examples. Do you have a favorite right now at all that you want to get into? No, you don't have to. No pressure.
Yeah, I mean, there's plenty of things I could mention. I think as I said, the Formula One case is interesting in terms of that concept of really strong business actually coincident with value catalysts, and helpful to think about that. We don't have to degrade the business quality just to get a value catalyst. I think for exceptional business quality and tailwind, GE Aerospace, which is GE is obviously spun into several companies, and Safran are very interesting. It's essentially they have most of their business is actually in a joint venture between them. So it looks like they've got 30% market share each, but actually they've got 60% market share. And if you look at the businesses, they've sold out their product for the next 5 years. So it's normally you're like, oh, where can I get my forecast right? Here it's like, no, it's already done. It's just not booked as revenue or profit. So it's a very safe forward trajectory. There's very high, one of the growth areas that are not so much on the news as an obvious point is defense spending. Defense spending in Europe is going from like 1.5% of GDP to 5% of GDP in less than 10 years. This is extraordinary growth industry. And so if you can find duopoly or monopoly type assets that serve the military and with very high barriers to entry, it can be quite interesting. And as I mentioned, flight as well, it's a growth, number of passenger flights per year is growing everywhere around the world. And you have to think of the world like, the Western populations aren't growing so much. But the world population is still growing. World population is going from 8 billion to 10 billion, again, around a decade. So there's good growth out there, but it's not just as simple as saying, I'm going to buy a supermarket business, that's in my country. You have to get exposure to world population growth. And the world is flying a lot more in all nations. Flight is really increasing. So I mentioned those businesses. And there's other things as well, by the way. Engine servicing is increasing because they want more fuel efficient engine. That means you've got to run the jet engines hotter. And that means there's more wear and tear. They need to be serviced more frequently. And the servicing is where the likes of GE and Safran make all their money. So you have growth well even above the industry level. But the reason I mentioned those two is because they're very good proxies for thinking about what's a really great business look like. And it's really good, I think, to have some of those in your portfolio, because then when you do a business that's like, okay, this is less good of a business, but it's very attractive because of price, or it's very attractive because of management or strategy or spin-off or something else. You've sort of got an intellectual anchor that you can help you price it relative to a really strong business. I do think the Fevertree case in the UK is a great case study, not well understood. The company is increasing its US distribution points by about 60 times with the Molson Coors deal. It's already well-established market leader, and new entrants in mixers and tonics and things like that come along about once every 100 years. It's very high barriers to entry. So you've got really very robust business, excellent management, owner managed. In my opinion, there is a probability there of an MBO because companies on the UK stock market don't tend to price that richly, and managers do take advantage of these things. And frankly, if they went to Molson Coors and asked for financing, I'm sure a conversation would be possible. So that's just an opinion, but I think that's also an interesting special sit value mid cap, and actually very strong business type of case study. So yeah, there's a few there. I don't know if you're happy to give you a lot more, but I don't want to overwhelm you.
So Adrian, how many stocks do you generally hold in your portfolio? Is it diversified?
About 30 stocks, and typically about 30 merger arbitrages. So in the arbitrage side, unless it's really asymmetric or just so high quality, I tend not to go too aggressive on the sizing because it is really a sort of probability statistics type trajectory. So, and if you've got good systems, you can find a good spread of merger arbitrages. So I tend to have about 30 equities and about 30 merger arbitrages, and that's quite aggressive, as you can imagine, in the sense of like you're you're spreading your knowledge quite widely. It's not so easy to be an expert in 60 different things. So I think that's about the hopefully the optimal level. We'll see, but yeah.
Excellent. And by the way, I didn't even ask. I mean, maybe you mentioned where are you situated? Where's home base for you?
In London, in Mayfair.
In London, okay.
My fund is European investor in terms of its typical investors. We have investors actually from all over the world in terms of Asia, South Africa, Australia, but not US. Just for tax reasons, it tends not to suit the US investors so well. So it's a little bit of an interesting thing in that I'm predominantly investing in the US markets, but actually most of my investors will not be US domiciled.
Excellent. All right, so just give us a few seconds in your book over here. You just published a book, The Super Organization Secret and Blueprint for Compounding Equity Returns. So what was the reason you wrote this book, and how long did it take you, and what's it all about?
Well, I think, it's interesting. As I mentioned, my fund went through this period where we had to change the manager in terms of the platform it was under. And actually, as we went through that process, we had to renegotiate some of the financing agreements, etc. There was just a little bit of admin, which meant we were running it slower. And I felt the best thing for me to do during that period was really just go into deep dive research mode, essentially make sure, all of the knowledge one picks up, but it'd be quite disorderly. You've got something in a notepad there, and you've listened to a speech there, and you've read something there, and you kind of know it all, but then you're not like, are you thinking about that exactly the right way? Would you like to research this a bit more, etc.? So, there was a period where I just thought, we have this great opportunity to really just make sure in all these regards, we've got the right intellectual framework for stocks and look closely at success stories in the past from investors and companies. And also recognize that technology does change the optimal investment approach. You can think of it like Ben Graham and the net type approach, and then it's like Buffett comes along and actually rejects his boss, who was Ben Graham, and says, no, because of color television, a brand that used to be regionally dominant can become nationally dominant. And that is a growth tailwind that is not recognized by the market. That was a technological change that before you couldn't have this sort of color branding and just, national essentially recognition of a brand. And if you look at a lot of Buffett's early investments, they were in that concept of brand goodwill. The brand goodwill is undervalued. And some investors today still copy that. It tends to be played out now, but they still essentially are influenced by that. Likewise, with the internet era, there was a form of business, the software network effect business model, which wasn't well understood by investors from the last, if you like, period. And so technology changed the optimal approach. And I think, what we're seeing today, and certainly in terms of workforce analysis, there's more you can do than you ever used to do. I mean, you can have APIs going into LinkedIn, and you can look at the average degree of everyone in a vast company. You can look at the employee turnover ratios. You can look at where did they work after they left, or where did they work before they joined. You can look at frequency of posting. You can look at all sorts of things in that regard. So the book really looks at the human aspects of businesses and says, well, what should be the principles then if I'm assessing a workforce, if I'm assessing corporate leadership, if I'm assessing division of labor within the workforce, if I'm assessing coordination. So, for example, Elon Musk is great at coordinating workforces, right? Everyone's like, of course, we're sweating night and day because we're going to go to Mars. It's a great coordination ideology. If you look at a company like Nike, it's actually being sued by its people because they feel it's discriminatory, etc. And it's actually got a lot of class action lawsuits by its own employees against the company. So that sense of analyzing workforce and saying, is this cohesively operating or not, is one of the dimensions. But it's interesting. I mean, my philosophy is the asset comes first and the workforce comes second in terms of what's really important. Monopoly or duopoly asset. But if you have multiple businesses with great assets, then the question is, well, what's the more attractive one? Well, it's one where the workforces and the leadership are really excellent. And I go through the principles in that book to think about, what determines that.
So
there's also a section at the beginning on the Buffettian approach and venture framework. So I sort of lead it from, let's say if you were sitting around investing, 40 years ago and take you up to the current day and I try and make it therefore a very current framework for thinking about all the tools that are available for us today to just try and get some extra edge in investing.
Are you basically, are you talking about what makes a great kind of team and what makes a good culture? Is that part of what the book talks about?
Yeah, we look for the principles there. Yeah, so you can look at companies that have great cultures and great teams, and how it's done, and how does a company create magnetism? Why does some Tesla? I think the year was 2022 got more job applications to it than the entirety of the number of U.S. graduates, including postgraduates from university. Now that is total job applications, including people who were in other jobs. So it's not a like-for-like comparison, but just a sense, magnetism and talent attraction are, important things. Concepts like mentorship is also very important, and it's a way to lower the cost of workforce, lower the cost of merit, right? If you can bring in young people who are maybe lower cost, but you can mentor them quickly, you can actually get the equivalent of very highly skilled people in a short duration at lower cost. So we look at all those characteristics, and we have to think of a company in the end. What is a company? It is a collection of humans who are collaborating with each other to collect cash for themselves, and they happen along the way to have issues of securities, and they're like, damn, we've got to pay some dividends on that as well. But ultimately, they're interested in collecting cash for themselves through collaboration with other humans. And why does a company exist? Is because there's so many tasks that we can't do as individuals. A simple example would be lifting a boulder. You just can't do it as one person. So you need to find 40 people who collaborate and all lift it together. Well, many of the tasks undertaken by corporations are like that, but they don't always stay like that. So example would be Uber versus autonomous driving. Uber's got, including its drivers, is the largest workforce in the world. So it was a scale-based task. You had to aggregate people to do it. Now you can have, I don't know how many it is, let's say 200 AI specialists in a room and all the cars and quite a small workforce, right? So, right. If the scale requirement of the workforce changes, then the business can be impaired. And so it is centered around the concepts of the humans in the business and trying to think clearly about both risks and opportunities in that regard.
Awesome. I can't wait to read the book. So it's called the Super Organization Secret.
And the secret, sort of so-called secret, is sort of, if we can line up all these principles in terms of workforce together in one, then you really have something, And interestingly, you would then say, well, what businesses have that today? And it's quite, it's quite.
I wonder how AI is going to change that view towards.
Well, this is also covered,
the view towards your employees and staff, right? I mean,
there's two ways it changes it, but one is that scale requirement of humans may not be in certain cases the same have the same need. So, for example, Amazon used to have a large workforce requirement in its warehouses. A lot of those lights are off now. It's just dark, and it's all robots. So, in certain areas where you can automate, the scale requirement reduces in terms of number of humans. And another change is that before, in order to achieve what I would call polymathy, right, where there's complex tasks in very different domains to be done, you had to have teams who had specialists in each domain working concurrently. So I need some guys to do engineering, and these guys do coding, and these guys they're just great at sales and marketing and promotion or whatever. Well, AI allows one person to have synthetic polymathy, a bit like I said earlier. No, I actually now do coding, which I never used to do, right? And before I would have to have a team for that. So there are changes, but what's not changing is exceptional, almost anti-authoritarianism entrepreneurship in the leadership. AI is not good at being anti-authoritarianism, but the great breakthroughs come, from that process. What's not changing is the concept of non-linear advantage, where if you own a platform or a network or a piece of infrastructure, AI can't just take that from you if someone else has AI. And I think the overseers of AI are going to be very valuable people as well. So I try and answer that. It's early to answer, but I try and answer it.
Yeah, no, it's going to be interesting to watch it all, right, and see how it all unfolds. I'm really.
I hope it's interesting and not just painful. But I think it's also like we've got this job decline in the US, or not decline, but slowing employment, and it's making the Fed cut rates or be more cautious on rates. But right. How much of that is AI? And so you could inflate a bubble here, right? Because people are very excited about AI, And the Fed thinks by lowering interest rates they'll increase employment. Well, not if it's AI causing the lower job, the lower hiring rate. So that actually would inflate a bubble if that, if they make that mistake of thinking it's interest rates being too high, that's causing the lack of jobs. So
you have AI that changing the way people are thinking since 2020, and there's there's a gig economy. There's a lot of things going on that I don't think are measurable by the usual economic data we get to. And it's really tough to kind of put your finger on how it's all going to play out, right? And I think it's interesting is like, okay, it's happening, and that happens. But it's just gonna hit. I wonder if it hits that like boom, right? Ah, shoot. Come on, Kate, it's out there. I'm still busy here. So yeah, so that's that's gonna be interesting to see how it all plays out. That was my call because I got a call coming up here. So sorry, Adrian. But this is gonna be a great conversation. I really enjoy you doing this today.
Yeah, it's been my pleasure. Thank you very much. I appreciate your questions and your insights and examples as well. So thank you.
We can definitely hook up again in the future. I'm going to get your book for sure, read it, and hopefully learn some good things. We're all about investing in quality management here. So that's really one of our tenets. So again, we've been here with Adrian Courtenay, Green Ash Partners hedge fund. And where can people follow you? I think is that your Twitter feed?
Well, I think, I mean, we've got the website of the fund, which is greenashpartnerscourtenay.com, and you can find me on a Google search as well. The most active feed I do is LinkedIn. I'm not particularly active, but I do post from time to time. But I'm also on X at the A-Courtenay handle as well. So we'll see if you retweet me more, Maj, then maybe I'll start using the account more.
I'll go find you. I'll be putting some of your quotes out there in your book, so don't worry about that. You might get tired of me tweeting you. All right, thanks, Adrian.
All right, best wishes.
Great to meet you, man. Bye bye.
You too. Bye.